The report on the US vacancies released yesterday reinforced their viewpoint that the US Fed has no excuse to raise interest rates higher. However, despite the optimistic data, Wall Street closed mixed on a Tuesday. The S&P 500 and the Dow Jones pulled back a little, but the Nasdaq managed to close with the gains. The main report in the economic calendar today is the ADP employment report. InstaForex analysts have already assessed the data. For a start, let's sum up the results of yesterday's session. The S&P 500 closed with a downtick. The index inched down by 0.06% to close at 4,567 points. The benchmark stock indexes traded higher in the New York pre-market today. Futures on the stock indexes added 0.2 and 0.45%, promising an optimistic opening. The intraday calendar for the S&P 500 remains roughly the same, from 4,568 to 4,598. A more optimistic scenario suggests a climb to 4,610. A more pessimistic one, a decline to 4,550. On a Tuesday, the energy sector and commodity sector put the most pressure on the S&P 500, so energy and commodity stocks lost 1.7% and 1.3% respectively. All in all, 8 sectors finished the session with losses. High-tech stocks cushioned the Nasdaq from a fall. Companies with a mega capitalization benefited from a decline in the US Treasuries and added from 1 to 2%. As for the economic calendar, the Joltis job openings report showed that the number of open vacancies dropped in October to the lowest level since early 2021. It indicates some softness in the labor market. In a separate report, business activity in the US services sector increased in November. Today, the ADP employment report provided fresh evidence that the US labor market is cooling down. The US private sector hired 103,000 employees in November, below 106,000 in October, and missing the consensus of 130,000 jobs. Services-related industries provided all the job gains for the months. The most active hiring was recorded in retail trade, transport, and utilities services. Hospitality and business services reported layoffs. Besides, wage growth again increased at a slower pace. Growth in the earnings of those who continued their employment rose by 5.6% last month, the lowest rate since September 2021. Those who changed a job saw a wage increase of 8.3%, the weakest growth since June 2021. This batch of data indicates that the Federal Reserve notched considerable progress in cooling down the labor market. It means that the regulator could begin the cycle of rate cuts next year. At least the market believes in this agenda, though experts warn against over-optimism about risk. Obviously, the economic growth has been skidding in the United States, so has the pace of hiring. In this context, futures on the US stock indexes went up. Stocks of most companies with a mega capitalization also traded higher in the New York pre-market. Nvidia shares jumped by 1.1% as the chip developer unveiled its cooperation with the US government with the aim of designing new chips for the Chinese market in line with the export requirements. In the currency market, the US dollar index responded to the fresh employment reports in the sour mood. Having climbed above 104 points, the index retraced to 103.90 and opened the New York trade at 0.14% down. The intraday calendar for the instrument is seen between 103.65 and 104.20 until the ADP data acted as an argument for the dovish reversal in the Fed's policy. The US dollar index had spiked to 204.07 earlier today, the highest level in 2 weeks. The catalyst for the intraday growth in the instrument is the weaker euro, weighed down by the prospects that the ECB might cut interest rates in March. The US dollar is also sensitive to such prospects. The greenback stays afloat during the silent period when Fed policymakers refrain from any comments ahead of the policy meeting next week. Besides, the Federal Reserve sends a more hawkish message than the ECB does. The US dollar also finds support from the fact that markets are afraid of over-optimism and take into account the warning of too high expectations of the Fed's rate cuts. Experts caution about a sharp retracement in the Federal Reserve reiterated that it's not going to lower interest rates in the near future. After the opening bell, the Canadian dollar is facing a challenge of the Bank of Canada's policy meeting. The regulator is due to announce its interest rate decision and provide a forward guidance. Markets participants expect Canada's central bank to keep its key interest rate at a 22-year high of 5% before easing policy as early as March. Back in October, no rate cuts were predicted for 2024. Economic data look like Canada's economy is on the verge of a recession. The economy unexpectedly shrank by 1.1% in annual terms and avoided a recession after the previous GDP had been upgraded. Still, Canada's economy looked a slowdown. This economic picture reinforces expectations that the Bank of Canada would soften its monetary policy. Anyway, the loonie will clear up its own outlook. Meanwhile, the crypto market is amazing investors, following a 5% jump on a Tuesday. Bitcoin challenged the high of 44,000, and the flagship crypto is extending its rapid rally. As of today, the token has surged by 161% this year. Bitcoin rose by 0.2% to open the New York session at 43,980. Popular altcoins are trading mainly in the green in the range from 1.5% to even 53.5%. Despite quiet trading today, Bitcoin is making efforts to settle at around 44,000. The bulls are coping well. The baseline scenario for the number one crypto is an intraday corridor between $43,700 and $44,350. If the lower border is broken, the price could slide to $43,100. Alternatively, the token could conquer the high of $44,750 and $45,000. That's all for today. Thanks you for watching. We are always open for your feedback. Subscribe to the channel and leave your comments and share your viewpoints. Good luck and see you online tomorrow.